We are on our way. Perfect. Okay. Everyone on the Zoom has the slides as well as everyone in the room. So if there is some type of technology malfunction, we'll probably just say, quick introduction, as Tim said, my name is Schiller. I'm the Technical Assurance and Quality Control Principal at Vrakas since March. I've been working in public accounting over 16 years now. I assist the audit group with risk assessments and audit methodology, as well as technical accounting standards and implementation. My contact information is here on the slide in case you have any follow-up questions or need anything, and you can always feel free to reach out, to your audit team, your audit manager, shareholder as well. We went over the housekeeping items. Okay, quickly the agenda. As I mentioned, we are going to spend most of our time on the lease standard, a couple of specific areas such as distinguishing between the two types of leases, discussing how the specifics of your lease are going to affect your accounting for the lease. We will talk about the expanded disclosure requirements that are required under the new standard, and also talk about next steps for your organization. And then we'll end talking about two other standards, one of which is the credit loss standard, and then we'll talk about reference rate reform. Okay, when was FASB 13, so the old standard, ASC 840 issued? November of 1976, so we haven't had a change to lease accounting in over 45 years. It was 77 pages long. The new standard is over 300 pages long. Gerald Ford was the president at the time, and one flew over the cuckoo's nest, won for best picture that year. So if this is the face you make when you think about leases, it's really explainable since that was the movie that year. So that being said, if there hasn't been changes to lease accounting for 45 years, why are we having changes now? The main criticism was related to operating leases and the fact that those leases were not recorded on the balance sheet. The details of those leases were just in the footnotes. So the issue was that it affected the comparability and transparency of the financial statements and the comparability between different organizations. So the most significant change under the new standard is going to be that all leases are now going to be recorded on the balance sheet. I say all leases, there is a small exception for leases that are qualified as short-term, which we will talk about the definition of that. It is a very narrow exception though, so for the most part, all leases are now going to be on the balance sheet. Essentially what this means is you're going to have a gross up because you're going to be recording what's called a right of use asset as an asset, and you're going to be recording a liability for the lease payments. So those two numbers are going to be very close in dollar amount. They're not necessarily going to be the same, and we'll talk about why, but they will be very close. So you've got an asset and a liability in the gross up, but it could significantly impact other ratios that your company or your lender might be looking at, such as a debt to equity ratio, because you're going to be recording this liability, but your equity is essentially going to be the same. When is the change effective? Finally, after all this talk and all this different going back and forth on the standard, the lease is effective for public companies for fiscal years beginning after December 15th, 2021. So essentially for a calendar year end company, that's going to be January 1st, 2022, which is right around the corner. So I thought since the revenue recognition standard was a 5-step model that we should put the lease standard into a 5-step model. So we're going to go through each of these steps in detail today, but this is kind of a nice overview for everyone. Step 1 is determining if your contract contains a lease. So before you apply lease accounting, you want to make sure that you have a lease. So the definition is on the screen here from the standard, but essentially a lease is a contract that gives you the right to use a specific asset, and think about property, plant, and equipment, the right to use that asset for a specific period of time in exchange for consideration. There are a couple types of contracts, or I shouldn't call it a lease, a couple types of contracts that are specifically scoped out. So it does not apply if a contract gives you the right to use an intangible asset, inventory, biological assets, or assets under construction. So again, when you think about leases, think about property, plant, and equipment. Once you've determined that your contract does contain a lease, There's another step. You have to identify the lease components as well as the non-lease components. The lease components are the portion of the contract that gives you the right to use that asset. So let's think about an office space lease. So you have a portion of the lease that gives you the right to use the space. You might have a non-lease component as well, which is giving you the right to a good or service. So in the example of an office space lease, a lot of times you also get common area maintenance along with the rental of the space. So the lease component is the office space, is the space part, and the non-lease component is the common area maintenance part. So under this new standard, you would identify those two units of account, or those two parts of the contract, and then you would allocate the contract consideration between those two components. Why? Because now the lease part of your contract is going to be recorded on the balance sheet, whereas that service part of your contract, the maintenance, is typically going to be expense. So if you're kind of thinking to yourself, gee, that sounds like a lot of work, I don't really want to mess around with all of that, you can elect an accounting policy election by class of underlying asset to treat both of those components together as a lease component. So you can save yourself the trouble of allocating your consideration between the two, which might make your accounting simpler, but keep in mind that it's also going to make your right of use asset and your lease liability larger, because instead of taking a portion of the contract consideration and allocating it to that non-lease component, which would typically be expense, you're going to lump it in with the lease component and capitalize it. There are several different accounting policy elections that we'll talk about throughout the slides that typically are going to make your accounting easier, they should, but it's also typically going to make your right of use asset and liability a little bit larger. So you're going to kind of do the cost benefit on that. Step 2 in the model is to determine the lease classification. And we're going to go through 5 kind of key ingredients to determining that lease classification. And overall, I want to just say that this is not significantly different than what we were already doing for determining the difference between an operating lease and a capital lease. Now it's called an operating lease and a finance lease, but essentially the finance lease is the same as the old capital lease. Commencement date. This might seem very straightforward because you're probably thinking, well, my lease has a start date, but that is not necessarily the commencement date under the standard. The commencement date is actually the date that you get access to this asset that you're leasing. And again, let's use office space as an example. We see many times that even if a lease contract starts, let's say on December 1st, that the lessee gets access to the space, the tenant gets access to the space maybe 2 or 3 months ahead of time, so that they can get into the space and build out some leasehold improvements for themselves. So under this standard, the commencement date is the date that you get access to use the asset. So it would be whatever date you get access to move into the space and start your leasehold improvements. Conceptually, that's not very different than what we did under the old standard for the deferred rent calculation. We would include that, that couple month period under that calculation as well. So, and it may be before, or it potentially could be after when you start making payments under the lease. So again, just keeping in mind that the dates in the contract aren't necessarily the key dates. It's really the date that you get access to that underlying asset. Okay, key ingredient number 2 is the discount rate. If your lease has a rate specifically stated, that would be your discount rate. 99% of the time, there is no rate stated in the lease. So then you would go to the next step here, which is you could use your incremental borrowing rate. And that would be the incremental borrowing rate if you were going to get a loan for a similar type of asset, similar term as the lease term, etc. A private company is allowed to make an accounting policy election to use their risk-free rate and that would apply to all leases. So the risk-free rate would be the 0 coupon bond or treasury bill rate for a similar term. So if you have a 3-year lease, it would be a 3-year treasury bill. Again, if you elect to use the risk-free rate, you would use that across your entire portfolio. There is an outstanding agenda on the FASB's list to determine if potentially you could elect this by class of underlying asset, but as of right now, you would have to apply it to your entire lease portfolio. Again, so this is another accounting policy election, which could potentially make your accounting easier. However, it would typically result in a larger asset and larger liability because the risk-free rate is going to be lower than your incremental borrowing rate. So you're going to be discounting less. Key ingredient number 3 is the lease term. Again, it might seem like that's very straightforward. If you enter into, let's say, an equipment lease and it's for 3 years, it might seem like, well, 3 years is my lease term, but what you have to consider are all the different options under the lease. And very specifically, you have to include the renewal options, or think about the renewal options. And you need to go through an analysis if you're reasonably certain to exercise the renewal period. If you are reasonably certain to exercise that renewal period, it would be included in your lease term. Obviously, this is going to be very subjective. Some things to consider would be your history of renewing the lease, as well as future forecasts. So let's say you have an office space lease currently, and you've been in that office space for 20, 30 years, a very long time, but your business projections for the next 3 years have you tripling in size or something like that. So now you're going to say, okay, maybe we've renewed in the past, but we don't see ourselves renewing in the future because we're going to have all this growth and we're going to need to move office space. So it is going to be a subjective determination. Definitely work with your accountant and your auditor on that. And another thing to mention is that the lease term, again, begins at that commencement date, which is not necessarily the start date of the lease or the start date that you make payments. It's when you get access to use the underlying asset. Number 4 is purchase options, and we'll just talk about this pretty quickly. If there's a purchase option, and the FASB went away from using that term bargain purchase option. So if there's a purchase option that you are, again, reasonably certain to exercise, you would automatically have a finance lease because they're basically assuming you're just financing the purchase of that asset. And then you would include that purchase option within your lease payments. And your lease term would only go through that period in which you're going to exercise the purchase option. If there's a purchase option and you're not reasonably certain to exercise the option, you just kind of continue going through the lease analysis. So again, if it's a purchase option that you're reasonably certain to exercise, you kind of stop because you're going to default to a finance lease. Otherwise, we're going to kind of keep going. The last key ingredient for our determination here is lease payments. So lease payments under the new standard include all fixed payments, so anything that's stated in the lease as a specific dollar amount. It also includes any variable lease payments if the variable lease payment is based on a rate or an index. So if you have a lease that says your payments are going to increase 3% each year, that would be included. If it's going to increase based on a CPI, that will be included. If it's going to increase based on something else that's not a rate or an index, it would not be included within the calculation. So an example might be if you have like percentage rents, if you owe additional rent based on how your company performs or how much revenue you have, you would not include that variable payment because it's essentially unknown. Some other payments to consider when you talk about lease payments are any lease incentives that you're receiving, and specifically wanted to point out those purchase options and security deposits as well. Okay, so those are our 5 ingredients for determining our lease classification, and very similar to the old model. If you trigger any of the criteria, you're going to be a finance lease. If you don't trigger any of the criteria, you're going to be an operating lease. And the next slide, we're going to go through these criteria. Under the old model, there were 4, and essentially they're the same 4 here as well. They've also added a 5th, which is the last bullet here, which is if the underlying assets is so specialized that the lessor would have no use for it at the end of the lease, that would be determined to be a finance lease. Now, what you might notice here is although the first 4 criteria are very similar to the old 4 criteria for a capital lease, they don't have the bright lines that we used to have, which we kind of love as accountants, right? So it used to say that if your lease payments were greater than 90%, if the present value of the lease payments were greater than 90%, of the fair value, it would automatically be a finance lease. Now they say if the present value of the lease payments is equal to or exceeds, quote, substantially all of the underlying assets fair value. So they're been a little bit more vague with these 4 criteria. Again, those bright lines aren't within the standard. However, the implementation guidance uses those exact same percentages. So as an example, the 90%, when they talk about a reasonable approach. So we can probably still stick to that 90%, the 75% as a reasonable approach. But I think what they were trying to get away from was structuring the lease so that the present value of the payments came up to like 89% of the fair value, because we saw that quite a bit in the past. So if you're at 89% of the fair value and it's close to 90%, you're probably going to say that that's a finance lease. But again, you have a little bit of leeway there, whereas in the past we really didn't. So once you determine what type of lease you have, you're now going to determine your initial accounting. The good news is that the initial accounting is the same. Sorry, let's go over the short-term leases first. So your initial accounting is going to depend on if you have, if you do qualify for the short-term lease qualification, you are able to expense those lease payments instead of capitalize. I mentioned the short-term lease exception is a pretty small exception because it talks about if on the commencement date of the lease, so again, when you get access to that underlying asset, if the lease term is 12 months or less, and there is an option to purchase that you're reasonably certain not to exercise, you could qualify as a short-term lease. But you have to, again, consider those renewal options. So when we talk about a quote lease term being 12 months or less, it's not simply the stated lease term within the contract. It would be considering any of those renewal options that are available. And if you are reasonably certain to exercise those, and that pushes you beyond the 12 months, then you would not qualify as a short-term lease. And we've gotten quite a few questions about month-to-month leases. If you have a month-to-month lease, you would also need to consider for how many months do you think you will continue renewing that lease. And if it's longer than 12 months, you would not qualify for the short-term lease exception. Under the 12 months, the FASB has put a pretty good bright line around that. They have said if your lease is longer than 366 days, probably accounting for a leap year, you do not qualify. So if it's 370 days and you might think to yourself, that's pretty close to 12 months or pretty close to 1 year, they say, no, that is not a 12-month lease. It needs to be capitalized. So we think that the short-term lease exception is going to be fairly minimal because there's so many restrictions around if it's actually 12 months or less. But that's not to say it's not possible. A lessee must still disclose. There are several disclosures around short-term lease expense as well. So you still, even if you do qualify, so you're not going to capitalize it and you're going to expense it, there are still some new disclosure requirements about that. Okay, if you don't qualify for the short-term lease exception, let's talk about the initial accounting. And this is the same for finance and operating leases. What you're going to do is take all those lease payments that you determined earlier, so the fixed payments, the variable payments based on a rate or index, and you're going to all those payments over the lease term and discount them back using the appropriate discount rate. As of the commencement date of the lease, not necessarily the start date of the lease contract, not necessarily the date that you start making payments, that commencement date. So that's the initial measurement of the liability side of things. On the asset side of things, you're going to start with that liability. You're going to add any lease payments that you've already made to the lessor, for example, a security deposit, and any indirect costs incurred by the lessee. And I'll talk about the definition of that on the next slide. And then you would take off any lease incentives that you received from the landlord. So if you got like a tenant improvement build-out allowance or something like that. The definition of these initial direct costs is more narrow under the new standard than it was under the old standard. It's a cost that the lessee has incurred that would not have been incurred if they had not signed the lease or fully executed the lease. So if you're spending time, let's say going to different companies and meeting with different companies and talking about different terms of leases, that would not qualify because you would incur those costs whether or not you end up signing the lease with that person or not. So an example would be if once you sign the lease, you have to pay some type of commission, that would qualify as a direct lease cost. So that definition is a bit more narrow than it was previously. So that's the initial accounting, the same under both types. What's going to change is the subsequent accounting. But another good thing is that the subsequent accounting for the liability side is the same, whether it's a finance or an operating lease. And it's the same as basically we've been doing under the capital lease model. You would reduce your liability for any payments that you actually made, and you would increase the liability to recognize that accretion of the discount. And if you wanted to double check yourself at the end of each period, that lease liability should be equal to all of your remaining payments discounted back at your discount rate. So the same accounting for finance and operating. What's going to change is how you're going to account for this right of use asset. So let's talk first about finance leases. This is a little bit easier, I think, conceptually, because again, it's very similar to the current capital lease model. So for finance leases, the types of expenses or costs you're going to have are the amortization of the right of use asset, which under the old model, we had the depreciation of assets that we capitalized. This should be recognized on a straight line basis unless there's some other reasonable method based on the use of the asset. You're going to have an interest cost, which is equal to the accretion of that lease liability for the discounting. If you do have any variable lease payments that you did not include under your liability because they're truly variable, so it's based on usage or based on performance, something like that, any of those types of variable lease payments under both models actually are expensed as incurred. And if you had an impairment of your right of use asset for some reason, then you would be recognizing that in the period incurred as well. In terms of the right of use asset for the financing lease, you're just going to be amortizing that right of use asset again, a straight line. So you're going to have your beginning balance minus the amortization for the period, whatever that's determined to be, minus any impairment loss, if you have one, would equal your ending balance. So here's, kind of mentioned earlier that your asset balance and your liability balance will be fairly close, but they may not be the same. And that's because your right of use asset is being amortized on a straight line basis, where your liability is being amortized under essentially the effective interest method. So they are going to be a little bit different. The costs associated with an operating lease are going to be strictly what they call a lease cost or a lease expense. So you're going to take all those lease payments over the remaining lease term. This is very similar to the deferred rent concept that we currently have. Take all those lease payments, divide it by the remaining lease term, and that's what you're going to recognize as expense each period, your lease expense. Any variable lease payments under the operating lease model are also expensed as incurred if they are truly variable and not based on that rate or index. So it might be kind of hard to see this little diagram at the bottom, but under the finance lease, you're going to have amortization expense and interest expense. And under operating leases, you'll have lease expense. Under the operating lease designation, your right of use asset, they actually, in many of the guides, call this the plug method, because essentially the amortization of your right of use asset is going to be a plug. The difference between the single lease cost, that straight line amount that you're recognizing, and the accretion of your liability for that particular period. The plug would go to the to decrease the right of use asset or amortize the right of use asset for that period. Any questions on accounting or lease classification so far? Okay. So to the final step here. Then the final step is we are going to present and disclose leases in the financial statement. Now, if you're someone who's been preparing your financial statements for maybe the same company for many years, and if you're thinking, gee, I would really love to have some new financial statement line items, this is the standard for you, because you can have so many new lines. You're going to present the assets and the liabilities separately for operating leases versus financing leases. And that's because the FASB sees them as different types of transactions. You're talking about a financing transaction versus an operating transaction. So potentially you could have two separate asset line items. You could have your right of use asset for operating leases and right of use asset for financing leases. If those balances aren't very large, you can potentially include those assets within another line item, such as other assets. If you do that, you just have to disclose in the footnotes where they are. Let's see. What else? Oh, okay, so then that would be on the asset side. On the liability side, you also have to segregate them. So you're gonna have a lease liability for financing leases and a lease liability for operating leases. So now you're up to potentially 4 new line items. But on the liability side, you also have to show the short-term portion of the liability as well as the long-term portion. So that could be 2 more line items. So you potentially could be up to 6 new line items under the standard. Again, if it's not a very large balance, you can include it with other assets or other liabilities, some other line item, as long as you then disclose where those are located. Okay, so that's presentation on the balance sheet side. We also kind of went over the presentation on the income statement side, but for a finance lease, you're going to have that amortization expense and the interest expense. And you would present those similarly to how you currently present amortization or interest expense on your financial statement. And on the statement of cash flows, it's going to be very similar to the current capital lease model. The portion of your lease payment representing repayment of the principal would show up as a financing activity, and the portion of the lease payment representing interest would be classified the same as other payments on debt, so typically operating, assuming that you're not capitalizing interest. Any type of variable lease payments, those actual variable lease payments, not the ones based on a rate or index, are going to be an operating activity because you're just going to expense those as incurred. For an operating lease, you're going to have that single lease cost, that straight line lease cost that you're recognizing, and that would just be classified as operating on both your income statement and the statement of cash flows. Any questions on presentation? Disclosures. So obviously we're seeing a trend in the FASB loving disclosures and wanting more and more disclosures, and this standard is definitely no exception. There are very many new requirements for disclosures. A lot of this first stuff is kind of similar to what we were already doing. Some of the differences though are this last checkpoint here, some of the significant assumptions. So whether your lease contains a contract, how you're allocating the consideration, if you choose to allocate the consideration, and significant judgments involved in your discount rate. There's more. Let's see, your financing lease cost has to be separated from your operating lease costs, also has to be separated from your short-term lease costs. And I think the 2 biggest ones down here that kind of stood out to me were the weighted average remaining lease term as well as the weighted average discount rate. So those are currently not required disclosures, that would be new. And there's still more. You still have the maturity analysis of your liabilities, so that's going to include all of your leases now. Lease transactions with related parties, that's something we already have. And then there's a bunch of practical expedients that you can elect when adopting the standard, and we're going to talk about those next. So you have to disclose any of those practical expedients that you've adopted. And yeah, there's a couple different options here, and again, these are kind of like accounting policy elections. You can choose if you want to adopt them. So we will talk about those. Yes, okay. Transition methods. So there's essentially two methods. Method A would be, let's say you're a private company and your calendar year end. So you're going to be adopting the standard January 1, 2022. Let's say your first reporting period is December 31st, 2022. And you issue these comparative financial statements. So you've got a 2022 column and a 2021 column. What you would do is apply ASC 842 to both of those periods, even though you only adopted the standard in 2022. That's method A. Method B would be that you would only apply it beginning in the period in which you adopted it. So you would show the 2022 column with adopting ASC 842, the new lease standard, and you would not have to go back and restate 2021 for the new standard. You would still keep ASC 840, our existing model. So this is kind of what it would look like. Method A, both columns would be under ASC 842, and under method B, your prior year or before you adopted the standard would still be under the old standard. So they provided this as a relief so that you don't have to go back and apply the standard to 2021. So we think that most people will probably choose method B in this case. And some things to note. So if you do choose method B, you still maintain ASC 840 in the comparative period. You would provide the disclosures that are required under ASC 840 for that comparative period. You don't have to go back and include the disclosures under the new standard. And then you would recognize the effects of adopting ASC 842 as of the period of adoption, so as of 1/1/2022. You would not need to restate 2021. Well, that's one reason why we think people are probably going to go this route. It only changes the timing of when you're adopting the standard. It doesn't change how you adopt it or anything like that. And this was intended to give people a little bit of relief from adopting the standard and transitioning. So, whichever method you choose, A or B, there are a couple other practical expedients that are provided in the standard. Very creatively called a package of transition practical expedients. And there's three kind of options under that package. You do not need to go back and determine whether a contract contains a lease. So if 5 years ago when you entered into some type of contract and you said that's not a lease, you don't have to go back and reassess that under the new standard. You're just keeping your existing lease portfolio. You don't have to go back and reclassify leases to determine if they're operating or financed. You keep the existing classification. And you also don't have to go back and look at any initial direct costs that were capitalized to see if it still meets the capitalization rule under the new standard. So essentially, you just don't have to go back and reassess a lot of stuff if you elect this package of transition practical expedients. So again, we think most people will probably elect to adopt these. If you adopt one, you have to adopt all three of these together, though, it's something to note. You can't just do A and not do B and C or something like that. They are a package deal. There is another practical expedient called the hindsight practical expedient, which means that when you are assessing your lease term, you don't have to go back and reassess, let's say, if you're reasonably certain to exercise those renewal periods. So maybe when you first entered into a lease, and maybe it was a 5-year lease, and you had a couple 5-year renewal periods, and back at the beginning of the lease, you probably would have said, oh no, we're not going to renew those. You don't have to go back and reassess based on hindsight, because maybe you actually did renew those. So again, you don't have to go back and, you can go back and say, well, in hindsight, we now know that we are going to renew those leases. So you would include that in your lease term. Okay. Any questions on transition methods? If you elect one of these practical expedients, you have to apply them to your entire lease portfolio. So you can't pick and choose leases. And there are disclosure requirements around which transition practical expediency you choose, and the disclosures are a little bit different depending on which transition method. So I have a couple miscellaneous topics to touch on now related to leases. First being related parties. So obviously we work with a lot of privately held companies and there's a lot of related party leases involved. So I want to talk about the difference between the old guidance and what you may have discussed with your accountant or auditor under the old guidance versus the new guidance. So the old guidance specifically contained this wording that said related to related party leases, that you should modify the classification and accounting for related party leases as necessary to recognize the quote economic substance of the transaction rather than the legal form. So that was very specifically pointed out. The new standard does not contain that language whatsoever. It has about one paragraph dedicated to related party leases, and it says that you should, the top here, that related party leases should be classified in accordance with the lease classification applicable to all other leases. So essentially you're not going to have kind of like, well, this is a related party, so we should consider these renewal options and we should consider the terms separately since it's related party. You're going to consider those terms exactly the same as you would on a third party lease. So that's a very significant change. The other item I wanted to point out was about, maybe you're thinking, oh, do I have to do this calculation for laptops or for smaller items? The international standard does actually specifically have an exemption for what they call small ticket items under $5,000. The FASB elected not to put that guidance in ASC 842. So there is not a specific exemption for any small ticket items. That being said, you should always consider materiality, and on many webcasts that I sit in on, they mention, you know, your capitalization policy is probably sort of a good number to be looking at when you're talking about, is this small ticket, should we go through this calculation, those types of things. So after all this discussion and all these little details, all these little nuances that are important in your lease accounting, perhaps you thought that the lease accounting standard would be pretty easy to adopt, not that big of a deal, but we kind of talked about all these little details and these different things that play into the calculation. So you can definitely elect to do your own calculations in Excel, make your own determinations, or find your own software provider. We have decided as a firm to partner with a software called Lease, which will do all of these calculations for us in the back end. And it will allow us to put in all those different types of accounting policy elections that we talked about, and it will flow through the calculation pretty seamlessly. So there's a lot of different things that we looked at when we looked at different software providers. This software was the easiest to use, most user-friendly, and gave us really everything that we wanted on the output side of things in terms of reports. So what we foresee is that we will be using Lease for our clients, sort of how a lot of clients, and we work with clients using BNA for fixed assets at this time. So we would get the client's information about all the different leases, put it into the software, and then the software would generate the journal entries that you need for each reporting period, and all types of different reports, including footnote reports. So it will spit out a report that has all that different footnote information that we talked about, including that weighted average maturity analysis, the weighted average discount rate, all of those things. It can report under multiple standards. So if you're going to have a comparative financial statement and one is under ASC 840 and one is under ASC 842, it will provide the reports for both of those different standards at the same time. It will generate all of the amortization schedules that you need. Again, all that footnote information that you're going to need, it's going to generate that based on the information that we input for each specific lease. And it's also, as the auditor, from the auditor side of things, it also is going to have all the details supporting those footnotes. So if your auditor asks you for, how did you get this discount rate, it's going to have the drill down details so that we can look into that. And once we get through the presentation here, I'm actually going to quickly, if we have time, pull up the Lease Query site so that you can just kind of see the reports that it's going to generate. Now, next steps, whether you determine to do the lease accounting on your own and do your own Excel spreadsheets, or whether you determine to work with us using Lease Query, you're going to have to get an inventory of all of your leases. Gather all that paperwork so that you can have all of those little details of the leases. Consider existing contracts that maybe you did not think were a lease under the old standard. An example would be if you have a cloud hosting arrangement, are you potentially actually leasing a server versus just paying for a service every month? And another good thing to look at in terms of completing your lease inventory is your general ledger accounts. So wherever you're recording lease expense, rent expense, those types of things, and making sure that you've got that contract captured so that you have a complete inventory. And then performing a lease abstraction to get those key terms and conditions. So one of the nice things about the Lease Query product is that it has an Excel spreadsheet with columns for these key details. So we can work with you to complete this Excel spreadsheet and then just upload it directly into Lease Query instead of having to put all those different details into multiple Excel spreadsheets. Any questions on leases? Do we have anything in the chat? Okay, let's. Don't want to forget our Zoom people.
I have a question on those operating month leases.
Yeah.
So let's say a company had a lease at one point, but they've been there so long that it just sort of, the renewal options of the lease are all done, or whatever. They just keep paying one month and they never sign the lease.
Mm-hmm.
So you just arbitrarily say, okay, we think we're gonna be here another 5 years, 10 years. I mean, how do you come up with that time?
Yeah, and I mean, that's a great question because.
You say the owner's gonna retire in 5 years and maybe then?
Yeah, I mean, it's very.
I'm just asking because it's like a month.
Yeah, and it is very subjective, and there's gonna be so many different factors that play into that. If you think you're gonna renew for 1 year versus 2 years, you know, however many years. I don't think that's gonna be different for every single person and every single company, you know.
So you just kind of pick a number. And
Yes. Yes, exactly, and it's gonna change, right? Like, you're gonna maybe say at the beginning of a lease that you don't expect to use the renewals, and then you do, and you're gonna change your accounting at that point, or vice versa. You're gonna say, okay, we expect to use all these renewals, so we expect to be here for 20 years, and maybe you end up only there for 7 years or something. So there definitely are gonna be changes in the assumptions and in the estimates, for sure. Yes?
We're gonna use the microphone.
Oh, so I'm sorry.
Because the people on Zoom can't hear us. So for questions.
So is the standard equally applicable to the lessor?
Great question. So I did focus on the lessee side of things. From a lessor standpoint, a lease is a revenue transaction. So technically the revenue recognition standard is going to change their accounting or rule their accounting more so than this lease standard. So there are a couple little nuances in terms of like variable lease payments and things, but for the most part, the lessor is going to be applying revenue recognition model. Any other questions? Just have a question.
I do, Kara, thanks. Can you speak to two things? I noticed there's a few slides that mention impairment of the right of use asset, and what types of items or instances would cause an impairment on a right of use asset, I guess. And my second question then is early adoption. Now, most standards allow for early adoption. I don't know if you touched on that. And then maybe who would want to do that this year? Or what would be reasons that folks would want to get proactive and get after it actually this year instead of kicking the can down the next year?
Sure. So let's start with the impairment. Let's say when you did your first analysis and it was a 5-year lease with a 5-year renewal, and you said, okay, we think we're going to exercise the renewals. You had a 10-year lease and you recorded this right of use asset for 10 years worth of payments and a liability for 10 years worth of payments. And then 3 years in, you realize for whatever reason, you might stay for the 5 years, but you're definitely not going to exercise that renewal option, that would be an impairment of your right of use asset at that point. So they're seeing in the industry right now, actually a lot of impairments of right of use asset from public companies who adopted, a year or two ago, because due to the pandemic and changing work styles, people are abandoning their office space or abandoning, certain assets. So there have been quite a few impairments of right of use assets, actually. The second question was early adoption. So yes, you can early adopt. I would think the reason someone would want to early adopt is if the new standards maybe favor them at some point. So maybe you like how the new standard applies to related party leases more than you like how the old standard treated related party leases. Similarly with sale leasebacks, there's a little bit of difference there in the sale leaseback space. So we actually did have one client early adopt because they did quite a few large sale leasebacks and they liked the accounting under the new standard more than the old standard. So I think people would early adopt if maybe they see it as a favorable change for some reason. Any other questions? Yes, great. Gonna get the microphone over here.
Could you just clarify for me on the classification of short-term leases? Are we looking at that from the standpoint of the original lease date, or if we're like 4.5 years into a 5-year lease, can we consider that because we only have 6 months left? Can we consider that a short-term lease at this point, or do we go back to the original date?
If you elect the package of transition practical expedience, you don't have to go back and reevaluate. So as of the date of adoption, you would have the 6 months left. Any new leases going forward, you'd have to do kind of this whole analysis, but that's a great question. So if you elect those practical expedients when you adopt, you don't have to go back and reassess.
Like that for all of them.
Correct. Yeah, it's for your whole lease portfolio. No questions from the chat? No. Okay. Well, that's leases. Most exciting. I guess exciting is relative in that sense. Okay, we're going to go quickly over 2 other accounting standards that are going to, once you get over lease accounting, you get to face these other 2 standards. So the first one is credit losses. And I think when this standard first came out, it was issued in 2016. A lot of us, including myself, thought it mainly pertained to banks or finance companies, people who had loans, things like that. But it actually applies to anyone who has receivables. So if you have trade receivables, AR, this standard does apply to you. It was initially issued as ASU 2016-13, called Financial Instruments Credit Losses. It is commonly referred to as CECL, the current expected credit loss. And this standard really came out of criticism from the credit crisis that there were companies who knew that they had big losses coming prior to the credit crisis, but because the current model is what's called an incurred loss model, they couldn't recognize those losses early enough. So the FASB has been working on this standard since the credit crisis, so over 10 years now. It's gone back and forth many times, many different comment periods, and it has finally been issued. Again, it applies to financial assets that are carried at amortized cost. So yes, it does apply to loans and loan portfolios, and that's a big change for the banking industry, but it also does apply to trade receivables and investments that are classified as held to maturity. So it's going to eliminate our prior loss model, which was an incurred loss model where you recognize losses when you thought that a loss was probable, which is a pretty high threshold, right? You have to be pretty sure that it was going to be a loss to be probable, and that's when you recognize the loss. The CECL model is a forward-looking model. It will require you to develop an estimate of credit losses that you expect to incur over the contractual period of the asset. At the same time, it will replace several existing models. So right now, there are a couple different models for impairments or for losses. So for loans, you know, a bank has a loan portfolio that has a whole separate standard on how to account for that. For investments, there's this whole separate standard, OTTI, other than temporary impairment. This new model will replace many of those old models, so there's really only one model, regardless of the type of asset. So under the new model, you are going to consider your historical experience. So historical experience maybe by industry or by customer type, the current conditions that you're aware of, and also reasonable and supportable forecasts. So looking forward to economic conditions and market downturn, potential market downturns or market upswings. So you're going to use all three of those, historical, current, and future, and determine your initial loss estimate. And then over time, as you change these different assumptions into the model, any updates to each reporting period are going to go through the income statement. Let's see, the allowance for credit losses can be developed using a variety of different models. There's no specific structure in place for that. A loss rate methods, probability of default methods, as well as you still can use a schedule of aging as the basis for your loss determination. Expanded disclosures in the new standard, of course, but many of the disclosures in this new CECL model are based on a standard that has already been issued, ASU 2010-20 receivables, which really was applicable again to a lot of banks at that time, but this standard maintains a lot of those disclosure requirements. And it would be adopted through a cumulative effect adjustment to retain earnings as of the beginning of the period of adoption. So a modified retrospective approach. Now, if your receivables are long-term, this probably has a much bigger impact on you. If your receivables are short-term and turn pretty quickly, 30, 60, 90 days, probably not as big of an impact because really you're not looking forward as much in considering all these different things that potentially could happen over the life of your receivable. But it is still technically applicable and you will be adopting it. There are no special provisions for private companies. And when I say that, I mean, there are some disclosures that are for public companies only and not private companies. But what I mean is there's no, you know, sometimes we'll refer to private company GAAP or small GAAP or something like that. There are no exemptions like that at this point. Private companies would be adopting this particular standard. Effective for fiscal years beginning after December 15th, 2022. So again, for a calendar year in the company, it would be January 1, 2023. So next in 2022, you're going to be adopting leases, and in 2023, you will be adopting CECL. Has anybody been hearing anything about CECL? Maybe just that term, CECL? No. Okay. Okay, we'll talk more about this one then. Next year, after we get over leases. Next one I wanted to talk about was topic 848, which is called reference rate reform. So essentially, as some background, what's been happening is a lot of lending agreements are based on LIBOR rates, London Interbank Offered Rate. The regulators have determined that they're going to phase out the LIBOR rate. So at that point, then people are going to have to restructure their debt agreements to become referenced to a new rate. Typically, accounting for contract modifications is pretty complex and it can result in gains and losses at the time of the modification. So this particular standard actually provides relief from the existing accounting for modifications to make it easier if your contract is only changing because of this LIBOR rate issue. Or I think they're actually discontinuing a couple other reference rates as well, but LIBOR is really the one that we see the most. So this standard really actually is to help everyone. FASB probably says all standards are to help people, but I think that this one really, it is to provide relief from that more complex contract modification accounting. Again, no specific provisions for private companies, so there's no small company gap related to this. This relief is currently effective through December 31st, 2022. But then earlier this year, the regulators announced that they were actually going to maintain LIBOR longer than they originally said. So they're going to continue publishing LIBOR until June 30th, 2023. In which case the FASB will most likely expand or extend this standard to provide that relief for a longer period of time. However, they haven't actually done that yet. It's still on their agenda, but we do expect that it will be extended to coincide with the timing of the phase out of LIBOR. Has anyone been hearing anything about reference rate reform? No, okay. We'll continue talking about it. That's a little bit further. Actually, maybe a better question is, does anyone have agreements that are based on LIBOR? Okay, a couple hands, so. Your lenders might start talking about it, things like that. Any other questions on any of these standards that we talked about or anything else? This is either reflective of how excited you are that you learned all this information today, or how excited you are that it's going to be over soon. I'm sure it's number one. Okay, what I do want to do now is take a couple minutes just to show you the lease query software in case you are interested in using that. So you can see some of the reports that it's going to generate. Okay, great, now I have to use the software, so the technology. I'm going to stop sharing so I can stop sharing, okay. And then go to the internet.
Yeah, find it.
Let me just make sure I'm still logged in. Okay, I'm gonna try this again. Oops. No. Let's just save that.
The screen share.
Okay, now I'll go back to the Zoom. Oops, back to the Zoom. And screen share.
Yeah, that's fine. Yep. Okay, and I'll confirm.
Okay.
So go ahead.
Yeah, we'll have someone confirm. Okay, perfect. So, from a user standpoint, what will happen is us at Vrakas, we will log into Lease Screen. We'll be maintaining your lease accounting for you. Again, similar to what we do for a lot of clients' fixed assets at this point. So we would log in, and up here where it says clients, we would drop down to your client here, and then we would have all your lease information. So I'm just going to quickly go through a couple things so you can see the ease of entering the information. So when I go to enter a new lease, one of the things it asks me right away is what type of lease I have. And this would be based on my initial determination. As I go through the software and enter the key terms of the lease, it's going to tell me if I'm right or not, basically. So I'm going to say that this one's capital. And then I just kind of went through, let's see here, you just put in some information. I'm going to say it's a building lease, the address. Some of this stuff doesn't particularly matter. You can put in all the contact information for the different people involved in the lease. I'm going to pass through this. This is kind of a key screen here, so all the different dates. So you're going to enter the lease execution date, as well as that commencement date and the possession date. Because again, like we talked about, the date that is really key is when you take possession of the space. The lease end date. A key thing here is the useful life of the asset, because that's one of the determining factors, and if it's a finance or a finance or operating lease. And then there's all these different options down here. Do you have an option to renew? If I say yes, then I'm going to enter all this different information. And am I reasonably certain to exercise the option? Things like that. What would be the rent under that new renewal? Because it's gonna use that information to calculate my total lease liability. An option, if you have an option to purchase, you would enter that. So we can enter in all the different terms here. Hang on.
I must have hit something I didn't want to there. Okay, I'm gonna go next. So then what I did here is I entered in the amount of my fixed payments. So I said that it was $1,500 monthly. And then I also said that it was going to increase by 3% each year. And so then what it does is it generates not only my payment schedule for the entire lease, but also if I go down here, I could generate the amortization schedule. So it would do that, the amortization for the lease liability for me. I also put in here my borrowing rate. So that's important for when it generates the amortization schedule in order to know the accretion of that discount. And then further down here, it also asks for the fair value of the asset. Again, that's a key component in the determination of whether you have a finance or an operating lease. So if I go to hit next at this point, it's going to tell me that when I initially entered this lease, I said it was capital. However, because of all these different factors, the software thinks that the lease should be classified as operating. And do I want to change the type of lease? So I would say yes. So I guess I just point that out because, you know, you can have your initial determination maybe, but if you haven't done all the calculations and considered all the different factors, you really can't come to that conclusion yet. So this software really steps you through every single decision point and every single piece of information that's important for that determination. So I'm going to close this for now. The other thing that I wanted to show you in here is if all your leases were in here, what you could do is go up to this entries tab and you could generate your journal entries for your reporting period. So I'm just going to do it for the total organization here for September 2021. And I'm going to say that I'm under GAAP standard. I'm just going to hit go. And it's thinking about it here. And then when I scroll down, it has the journal entry that I need to make for this period. The other thing that it has is not just the journal entry that I need to make, but I can go over here to account balances and it would tell me what my ending account balance should be for that period as well. So that'd be kind of a double check after you do your journal entries. So it can generate those journal entries for you. The other thing it has, if I go up here to reports, is I want to show you the footnote report because it can generate all that footnote information that you're going to need. So one of the standard reports is called Complete Disclosures Report. So let's pull that up. So down here is basically if you had done the journal entries based on what the system had, this is all the information that you're going to need for your footnote disclosures. Here was your amortization of your right of use asset for finance leases, your operating lease cost, short-term lease costs, variable lease, etc. And if we go all the way down here, it gives you your cash flow information, your weighted average lease term, because that actually has to be broken out between financing leases and operating leases, and your weighted average discount rate for financing lease and operating lease. So this is an excellent report to provide you all the disclosures that you need. And as I mentioned, it also has basically like drill down capabilities so that your auditor can go down to the detail and, you know, test a couple leases or test whatever they need to test to get comfortable that the schedule is accurate. Any questions on lease query or software options? Yes, Gina.
Do you at this point have the Excel spreadsheet available that would be used as a template?
Yes, okay, so Jana's question was, do we at this point have the Excel template available that would be used as a template? You're talking about to upload everything in here? Yes, we do. So we can work with you on the Excel. It'd probably be, you know, a pretty quick call to just explain the various columns in the spreadsheet and the data that you need to populate in terms of kind of the abstract of the lease terms. But yes, we have that template already available. Okay, any other questions? Anybody on Zoom? No? Questions? Okay. So as I mentioned, this does qualify for CPE, so just make sure that you sign in and complete your survey if you need the CPE credit. Oh, a question on Zoom, okay.
I presume there would be minimal impact for debt covenants. Any issues or negative impact you see in this area, debt to tangible net worth and such?
Yes, so obviously it depends on each company's debt covenant and how that covenant is defined with the bank as well. But yeah, pretty much like a debt to equity debt covenant is going to have a significant change because your debt is going to go up, but your equity is going to stay the same. But again, it depends on how your bank and your lender is defining quote debt. Maybe the bankers seem pretty aware of the standard actually. So it could be that they're going to change the debt covenant and how they define the debt covenant, or it could be that internally they just kind of know that they're going to adjust liabilities by the lease liability. I'm not sure, but yes, potentially could have an effect on your debt covenants. Good to start talking with your bankers as soon as possible because nothing's changed in your business, right? Everything's the same. There's just this accounting standard change, so. Thank you for the question. Anything else? All right, well, thank you everyone for attending. We appreciate your time and hopefully it was beneficial. And I did have my contact information on the slide, so you can reach out to me if you have any questions or reach out to your auditor or your team. And thank you so much.